Thank you for this very kind invitation to be here. And I didn't know that I was the first recruited speaker, but I'm honored to be here as well. And one of the questions that was open this morning was the link between inclusiveness and natural catastrophes. So I'm going to address these. Let me tell you a story. The picture you're looking at in the screen is happening in September 2017 in Mexico. September 2017 was a very bad month for Mexico. There were two big earthquakes. One of this is September 7th, actually September 8th. Earthquake was at 11 p.m. In the evening, and all of a sudden, about 30,000 homes were severely damaged, and this was a 8.3 magnitude earthquake in the moment magnitude scale, and this is a very, very strong earthquake. This happens once every 100 years. And then half of Mexicans realized that they didn't have insurance. They didn't have a proper catastrophe cover insurance, and we commissioned a work with the Society of Actuaries and FIDES. FIDES is the Federation of Inter-American Insurance Companies. We basically surveyed quite a few insurance companies in the whole of Latin America to find out what are the problems. Now, how can you imagine insuring for an event that is going to happen once every 100 years? It's difficult to realize that. So there's the problem of frequency, also the problem of perception, because people think that they deserve something back from an insurance contract. So they pay premium, and then perhaps it's lack of understanding what risk is all about. They think they deserve a payback, right? But then the normal payout in a CAT event is zero, right? Because these are very rare events. Well, this happened in September 7th, and then September 19th, same month, same year, there was a 32nd anniversary of an earthquake that had happened in 1985, and it was very, very strong as well. Not as strong as this one, but the other one caused more damage. This is southern Mexico, so the region is not as populated as central Mexico. The second one hit Mexico City, and 55 buildings collapsed, and there were millions in damage. So basically, let me give you a bit of background about what are natural catastrophes. Then we analyze supply and demand challenges, and then how to narrow the gap. We don't say to close the gap. The gap is never going to be closed. It can be narrowed. And there are some ideas into how to narrow this gap. What is the gap? The gap between economic losses and insured losses. So there are many sources of risks. You know that insurance companies are the primary absorbers of risk in society. Insurance companies like risk. And here just a sample of risks. One, for example, would be the risk of political challenges that we are seeing in the news. I chose a picture of Merkel speaking at the World Economic Forum. I could have chosen Macron or Erdogan or whatever political leader. But I like this contrast at the World Economic Forum in Davos, Switzerland. We have populist agendas, we have Brexit, we have trade wars, etc. So these are external risks. Another category would be the changing consumer behavior, consumers buying different things, industries that collapse, right, or that change because of societal changes, new technologies, innovative business models, etc. Then we have natural catastrophes, all right? We have also the risks of global warming, cyber risks are up in the agenda, and natural and man-made events as well. So these three categories are external, and then just for the sake of completeness, we have an internal category which are everything that can go wrong with a corporation, with a company, like lack of a vision, lack of a strategy, business model failure, etc. So we are going to focus mainly on natural catastrophes. Now, let me show you this chart. This is 1970 till 2017. The bars, the vertical bars, are so-called man-made disasters, not necessarily terrorist attacks, but also an explosion or an accident, everything that is caused by the action of men. And then the line are natural catastrophes, earthquakes, floods, hurricanes, etc. And these are numbers, so in the y-axis we have the number of events, right? So there's apparently there's a trend to rise. Of course, 2005 we had 3 major hurricanes, Katrina, Vilma, and Rita, very devastating events. Now, for 2017, the economic losses were 337 billion. And this is a very large sum of money. Now, out of these, how many were catastrophes, natural catastrophes, out of these losses? Any idea? And I think in the morning we saw data for 2018. The losses were 160 billion, if I remember correctly. Contrast these with 337. How many of these were natural catastrophes? Any idea? Almost all of it, and only 7 billion in man-made. Now, out of these, they represent about 0.44% of the global GDP, and this is a huge amount. Very, very, 2017 was bad. Not only in Mexico, Latin America was badly hit. Peru was mentioned also in the morning. Peru had, Peru sits basically in the Pacific Ocean, close to the equator line, and there's a natural phenomenon called El Niño. You have heard of El Niño, the boy in English. And this is where the warm waters hit in the Pacific, hit the cold stream, and then this causes a lot of precipitation. And in Peru in 2017 rained a lot. And a lot means rain from February until April, non-stop and torrential. So these destroyed crops. There were, the problem mainly was mudslides, so a lot of mud, and people, thousands of people lost their crops, and it was a economic disaster. Okay, so out of these 337 billion, about 144 billion were insured, and the rest uninsured. Now here we see a chart of the red line here is the 10-year world average adjusted by inflation, and what we are showing are economic losses as percentage of GDP as a consequence of natural catastrophes in 2017, okay, by region, okay? So you see that US and Canada was the largest. Actually, it's the US. The US is a region where you have the risk of hurricane every single year from June until November. You know that. So people are used to buy property damage coverage, business interruption, etc. But this 2017 was 1.2 in the US. And then we have other regions in the world. We see, for example, Europe was 0.1% of GDP, okay, in 2017. And then the red line is, again, the 10-year average, which is 0.3%, okay? Now, this is the non-life gross written premium by region, okay? And then close to the bottom, we see Central and Eastern Europe with only 45 billion in 2017. But the number in parentheses is the growth, inflation adjusted, 3.3%. So normally emerging economies tend to grow much faster than developed ones. This chart contrasts Central and Eastern Europe on the bottom versus the more developed markets of Germany, France, Spain, Italy, the Netherlands, etc. at the top. And this one is interesting. What you see here is 2 years compared, 2016 and 2017, also by region. And then the green area is the insured losses, right? And the gray is the complement, what you would need to get the economic losses. And then the, Europe is, we have a yellow circle. About half of the losses were insured losses. Okay. Now, what are the challenges? Let's start with the demand side, with the consumers. What do you think were the challenges in Latin America when everybody realized, oh, we don't have coverage, we can lose our home like this, and we need insurance? What are the challenges? Well, basically, people do not understand insurance, okay? And companies don't do a very good job in explaining it to the public, okay? So this was the result of the survey, ranked in order of importance. Number one, consumers do not understand the products because insurance products are complex instruments. Regulators have two main tasks. One of them is to assure solvency, right? And the other, to work on market conduct, to promote insurance contracts, insurance policies that are easy to understand for the general public, etc. Affordability. Problem number two, consumers cannot afford coverage. Number three, consumers are not aware of the products that are available. Number four, in yellow here, oh, the government should pay, okay? And this is a survey. This is a survey that we conducted back in 2017. Consumers do not trust insurance companies. Okay, I pay my premium, and then I don't see. I don't know if the company is going to be around. Lack of consumer trust. Then nobody has ever tried to sell them a product, etc. But the differences in response were not significant. So it was more or less even. Is the lack of trust a fact? We have minimized not only in property but other type in insurance, but also in other types of insurance products. Well, apparently this is the reason. So basically, we see that policyholders have, or consumers have, a difficult time in trying to understand the products, and or the lack of affordability could also be an explaining factor. Now, on the supply side, insurance companies, well, many challenges. One of them is the cost of distributing insurance. It's very high. We found out that about 30% is spent in distribution and admin expenses, and this is relatively high, right? So if you try to sell insurance products and you have this cost, this exacerbates the problem on the supply side. What would be a solution? Well, adopt better technologies. We saw bright examples in the morning to streamline the process, to minimize this cost. Another problem from the insurance company side is the modeling skills. For example, modeling catastrophes is difficult. The skills are not there. Actuaries are not there. Only a few countries have actuaries. So we need more actuaries in the world. And the cost of modeling is very high. The lack of statistical information and expert systems add to the problem. What would be a solution here? A proposed solution would be to upgrade the talent skills. I don't know, to go to the AWB website and start a dialogue with AWB or with any other non-profit organization, establish alliance with universities, with government, etc., to upgrade the skills of the actuarial profession, or the insurance professionals in general. Another problem that we found were the challenges in product design. So companies are so focused in preventing fraud, okay? They spent a lot of effort trying to minimize the risk of fraud. And there is fraud in our industry. We cannot live without that. There will be fraud for as long as we live. But I guess here the idea would be to focus on dealing with problems that add value, right? Create value. So work on the redesign, the policies. In the morning also, we heard about simplified products, parametric coverages, which is basically index-based insurance, module covers, and lobby also for compulsory coverage and government participation. In certain countries, you cannot, for example, property insurance is mandatory, right? If you live in a condominium, right? So this would be part of the solution. Then distribution, right? How to sell insurance. Agents are really not interested in selling property coverage, and this is the case in Latin America, may or may not be the case in the Balkan countries. Agents make more money in commissions by selling automobile insurance, right? Motor third-party liability, because people are going to understand that and they need to buy it anyway. But then when the agent has to sell a property coverage, well, products are difficult. There's a lot of to understand, and the agent is basically not motivated because he or she is not going to get the right commission for the effort invested. So what would be a potential solution? To explore alternative distribution channels, I don't know, internet, online sales, simplified products, and obviously take advantage of InsurTech, how to reach the consumer. Okay? Then some institutional obstacles in many countries, and this comment relates to Latin America. The legal environment is weak, and that is, even if you have the law, right, the contracts are difficult to enforce. And of course, if you want to insure your property, you need to have a title, you need to have a certain documentation, legal documentation that makes you the rightful owner of the property, right? So these immature regulatory frameworks sometimes hinder insurance market development. Many Latin American countries are so focused in copying, pasting Solvency II, and regulation is sometimes very strict in certain countries. For example, Colombia, companies have to submit reserves to the regulator every month, right? So I think that's a bit too much to ask. And companies are, well, they do things because they are required to, rather than recognizing that it is naturally good to measure your risks and to know your profiles. What would be a solution here? Well, work with government institutions, establish an alliance between the private sector and the government. And I think in most cases, regulators are willing to listen to the industry and to establish such a dialogue. All right, then how can the gap be narrowed from this huge amount of economic losses to the losses that are actually insured? Well, here let's propose 5 actionable things that could be done to narrow the gap. We start by promoting insurance culture and financial inclusion. And we know by now what inclusiveness in insurance means. Right? Another solution, work on regulatory change. Not regulation for the sake of regulation, not regulation because I need to, we need to basically have say that we have now a Solvency II type regime, a risk-based regime, as opposed to the old Solvency I factor-based model, but rather trying to find the balance, right? And every time that we think of balance, we think of Mr. Popovsky in this robe. I think he's going to be famous for that after this conference. But I think it's important to find this balance between what is realistically achievable in a market. Now, Solvency II is not for everybody, in my view. Many countries are so small, or companies are also so small that sometimes when you sell imagine that you're a small company, you sell a big contract to a company, a very large company, your risk profile is going to change radically. And then next year in the renewal, you lose this contract, and then there's a lot of change that perhaps doesn't warrant to have a very sophisticated solvency system, right? So maybe some simplification of solvency rules come to question. The third, also strengthen product innovation, make products simpler, easier to understand, easier to underwrite, etc. Number 4, upgrade the skills of the actuaries and of the agents and of the management, right? Improve the ability to assess risk, understand what is risk. And number 5, which is like a catch-all category, create partnerships between the government and the private sector. Thank you very much.